Hi, class. Thank you so much for joining me online today. Today, we're working on Chapter 10 on pensions and other fiduciary activities. Pensions are the biggest one. We're going to spend more time on pensions, in part just because they end up being such a large portion of pretty much any municipal government's budget. Any, state or local government is going to have a large amount of money in their pension funds. So that's going to be where most of our emphasis is today. Okay. What is a pension? So pensions are typically considered like a benefit to employees. It's the sum of money paid to retired or disabled employees based on their years of employment. So if a teacher works for a district for 30 years, then they retire, they're going to be eligible if it was part of their compensation package that they had a pension plan, they're going to be eligible to get a certain amount of money each year. So employees earn the pension during the years of employment. The teacher earns her pension every year that she works for the district, but the government, in this case the school district, doesn't actually have to make the cash payments until that employee retires. So they create a big liability that often isn't due, for any given person, it's not due for like 10, 20, or 30 years. The benefits received in the cash payments may be mismatched by many years. The teacher may work now and not be retiring until 20 years from now. It is often included in job offers to make them more appealing. So a lot of times government jobs don't have highly competitive salaries or wages, but oftentimes they kind of make up the difference from the private sector by having better benefits, by having better, like more stable health insurance plans, or oftentimes by having pension plans. So for example, I went online and just this week found a City of Houston job posting that included a pension. So they're looking for somebody for the finance department, for the public works, looking for a buyer, and the benefits include a retirement pension. Okay. Why is pension accounting important? And I know you guys have heard from me before that I think pensions are incredibly important and that they are seriously under-discussed in the media because they're kind of considered antiquated to a certain extent. Not a lot of new companies are offering pensions. So for example, the auto manufacturers used to always offer pensions, but now they're less common. Now companies offer, 401ks, retirement plans where you get to choose how much money you want to put in, and maybe the company matches a certain percentage of it. But 401ks are basically like you are setting aside the money for yourself. It used to be, in the case where pensions were more popular, that the companies, or in the case of government and nonprofit accounting, the state and local governments would set aside the money. So CalPERS, which is the California Public Employees Retirement System, as of the end of 2018, they had massive amounts of assets. They had $360 billion in assets in their pension fund. But despite the fact that they had $360 billion, they were underfunded by $150 billion. And that's based on the amount of liability that they anticipate paying out in the future. They paid out $22 billion that year. Those are the people that are already retired or have been disabled in like a qualifying disability and are eligible for benefits right now. There are 600,000 beneficiaries right now in CalPERS. They're massive systems. They cover a large number of people across the country. Looking closer to here, Texas Teachers Retirement System, as of August 31st, 2019, they had $160 billion in assets, and they were $51.7 billion underfunded. And we're going to talk about how you calculate what the total liability is, and that's how you determine how underfunded it is. The funded ratio, so the amount of assets they actually have relative to their total accrued liability, is 76.4%. They have 885,000 active members and 405,000 retirees or people that are already eligible for those benefits. Houston Firefighters Relief and Retirement Fund, that's another one that's close to home here. They have $4.3 billion in assets. Their underfunded liability is only $900,000. So they're at an 81.4% funded ratio. And generally, as far as pensions go, anything that's more than 80% funded is considered, in a relatively safe position. It's also not terribly common. So the Houston Firefighters Relief and Retirement Fund has done a relatively good job of keeping that pension plan funded. They have 4,000 active members, and they have 3.3 thousand, so 3,300 retirees or beneficiaries. But just for some perspective, so the Houston Firefighters Relief and Retirement Fund is relatively well funded. It's 81.4% funded. So out of the total liability they have to pension, to the people eligible for the pension, they have 81% of it set aside already in assets. That's that $4.3 billion in assets. But still, the underfunding, that $900 million, amounts to $125,000 per person. So they still have a substantial amount of underfunding when you consider it on a per person basis, and they're one of the most generally well funded. Okay, so why does this matter? It has a direct impact on public policy as we're thinking about how governments run and what liabilities government have in the future, and whether they are serving interperiod equity, whether or not they're paying for what they're offering to citizens today, or whether they're kind of kicking the can down the road. I think pension plan liabilities are one of the biggest examples of how a lot of governments have been kicking the can down the road. They think that at some point they're going to get enough returns on their investments that they'll be able to make up this funding shortfall. Now, obviously, later on, we're going to talk about how the market changes are going to impact how underfunded a pension plan is. But obviously, even if you have a majority of the assets in a pension plan in government or municipal bonds, that market has gone down this week or in the past 2 or 3 weeks. Okay, so it's one of the most controversial issues of our era. GASB regulations and FASB regulations too have changed substantially in the past 2 decades to increase visibility into the liability associated with underfunded pension plans. So FASB has increased disclosures as well, and GASB absolutely has increased, and we'll see as we talk about it today what governments are required to disclose with respect to the pension plans for their employees. Okay, so why, in addition to why is it important, there are some difficult issues around pension plans. So the first one is that the amount of the eventual cash payments to employees depends on variables that are unknown at the time that employees provide service. So a lot of times a pension amount, the amount that is paid out to a particular person in retirement, is dependent on their number of years of service, what their final salary is, and a lot of those things can't be known. It's hard, they can estimate them, but they can't be known with certainty. It relies on the accuracy of actuarial science and the predictability of the future. I'll say I think that the authors of the text have a little bit more faith in actuaries than I do. I don't doubt that actuaries are trying their best. I think it's so impossible to predict the future that even if you give it your best attempt, it's still important to state that even though it's considered actuarial science, it's probably a little bit more like actuarial art. There's a lot of assumptions that go into it, and estimating it with any degree of accuracy is a challenge. Okay, it's not obvious how eventual costs of benefits should be allocated to particular years when the employees provide their services. We're going to talk about this when we discuss the calculations, how they allocate the cost. And then they're accounted for in multiple places. So this is the last element of the pension plans. It's important, and it's going to be important for this class in particular. So you have the actual assets. So the money that's been set aside by the government, and that's in a pension plan. So that's normally going to be in a fiduciary fund. And that's going to be that's going to have just financial assets. So that's going to have just bond holdings, maybe some equity holdings, but generally speaking, a lot of low risk kind of low risk to medium risk. So blue chip, equity, and municipal bonds. Okay. Then, so you have the pension plan, which is a fiduciary fund. Then you have your government-wide accounting statements. The government-wide accounting statements are going to report the total liability projected into the future. So we're going to figure out what that total liability is. That total liability is going to appear on the government-wide accounting statements. And then the last place that you're going to see pension-related entries is going to be the governmental fund statement. And so, for example, if we're talking about a police pension fund, or if we're talking about the fireman's pension fund, then that's going to be paid out of the general fund. So the general fund each year is actually going to transfer some cash into that pension plan to pay hopefully all of the liability for that year, all of the change in liability for that year, or if not, at least a substantial portion of it. Okay. So let's take a look at, as like on a state-by-state basis, how funded are these funds? So at least 8 states were 90% funded, which means that they're doing a good job setting aside the assets to pay that liability that they owe in the future. Washington, Oregon, Iowa, and Delaware. And then you have some that are kind of, middle of the road. Or actually, sorry, it was Idaho, Utah, South Dakota, Nebraska, Tennessee, North Carolina, and New York that are doing a really good job funding their plans. Washington and Oregon, Iowa, Ohio, and Maine, those are in that 80 to 89%, which is still good, still relatively well funded. Anything over 80% is considered generally well funded. Honestly, we should be trying to push and encourage governments to get very close to that 100% so that there are not outstanding liabilities. But you can see here, there's a lot that are in a fairly precarious position that are either, 60 to 69% funded or below 60% funded. And that includes California, Colorado, Arizona, New Mexico, Louisiana, Mississippi, Illinois, Kentucky, South Carolina, Pennsylvania. These are places that are at risk of not being able to pay those pension funds, those pensioners in the future. Okay, so state and local governments are not necessarily doing a really good job of, funding their pension liabilities. But what's the magnitude of this problem? The magnitude of this problem, state and local pension debt is a share of GDP, total U.S. gross domestic product. So, as a percentage of our economy, how underfunded are these? If it was even 1%, that would be a huge debt, a huge liability. But the truth is that it's somewhere between 8 and 10% of GDP. Now, as you can see, one of the other things is you can see the 2008 recession here, right? You can see that during the 2008 recession, these plans went from between like 2 to 4% funded all the way up to 8 to 10%. The underfunding went to 8 to 10% of the GDP of the country. Now, what we don't have is we have here, and we know we're out here in 2020, and we know there's pretty strong indication. The stock markets have gone into a bear market. Not only have they lost 20%, but I think the Dow Jones has lost closer to 30% at this point. We know that there's another recession happening here. And we'll show how this impacts the pension liability. But basically, if the percentage funded is the total amount you have in assets over the total liability, these assets, when the stock market is going down, when the bond markets are going down, these assets become less valuable, right? So your numerator is going to be shrinking. And so when that numerator is going to be shrinking, what that means is that gap, that amount that's underfunded, is going to be growing. So, it'll take a couple years for it to shake out, but if we were already at between 8 and 10% of the GDP is the amount that's underfunded in pension liabilities, my bet is that's going to go up again. It's going to take a while to figure out exactly where this lands, in part because most pension funds take at least a year to close out all their actuarial estimates and report to the public. So my best guess is, 2021 is the earliest we're going to find out exactly what the size of the pension liabilities is. So we'll have to see how that kind of plays out. But just something to be aware of, the underfundings, the pension liabilities, 8 to 10% of GDP is a substantial amount. Okay, so going back to, that's kind of the macro, what's going on, what's the context in which we're looking at pensions. Now we're going to talk about, the types of plans. We're going to talk about calculations here. So there's a defined contribution plan and a defined benefit plan. We're going to talk about defined contribution first because it's substantially less complicated. We'll have, very minimal discussion of it. And then a lot of our discussion is going to focus on the defined benefit plan because that's the more complicated one that requires more actuarial science. Defined contribution plan, like the name implies, is that the employer agrees to pay a certain amount. So for example, they agree to put 1% of your annual salary or 2% of your annual salary into a pension plan. And that's what a defined contribution is. So when the employer makes a defined contribution plan, they set aside whatever amount they have promised, they put it into a pension plan, and then they no longer have the risk related to that asset. They have met their obligation once they put that money into that plan. If the market goes up or the market goes down, they do not have to change the amount that they have contributed. They agreed to contribute a certain amount. They do not promise that it will be worth any particular amount in the future. If there's any gains, lucky employee, they're going to get, all those earnings on those assets that were put in there, all that money that was put in there, then all of that benefit goes to the employee. On the other hand, if, for example, you had a defined contribution plan, let's say you had $50,000 set aside by your employer in that defined contribution plan. And then, for example, what happened recently, you have a bear market and all of those holdings, those bonds and equity holdings that you had in that pension plan, they decline in value 20 to 30%. The employer has no obligation to make any additional contributions. All of the risk of gain and loss, that's all on the employee. Okay. A lot of times defined contribution plans are used because they're more portable. And then the employee bears all the investment risk. Okay. Okay. On the other hand, and this is what is going to be more important for our discussion today, because a lot of state and local governments use defined benefit pension plans. So as far as corporate America goes, we're not going to do too much into this because this is not the point of the class, but just as an aside so you have some context, defined benefit pension plans used to be more popular in like manufacturing and airlines. For a long time, the unions lobbied fairly heavily for defined benefit pension plans to exist for corporate pension plans. There are not, generally speaking, any new defined benefit plans, defined benefit pension plans offered by corporations. They've quit offering those. Now they generally use defined contribution pension plans or 401ks instead. Because a defined benefit pension plan requires, there's a big burden on any employer who uses a defined benefit pension plan. If you have a defined benefit pension plan, you have promised the employee, instead of saying, I'll contribute 2% of your salary every year, with a defined benefit pension plan, you've said, I promise to give you X amount during retirement. So for example, if you work for 30 years, I agree to give you 90% of your last year's salary every year in retirement. That's a defined benefit pension plan. You promise them what you are going to give them in the future. And that's what requires a lot of actuarial assumptions, because you have to figure out, what portion of your employee base is going to be retiring each year, how many years of service have they had, what is their final salary going to be, how long is it going to be, and then you have to figure out, like, is it that you pay their pension benefits until they die? Then you have to estimate when they're going to die. And I know that's a little bit morbid, but that's a large part of what actuarial science is. A lot of part of actuarial science is figuring out life expectancy, because if you promise somebody a pension from the day they retire until the day they die, you have to estimate, is that going to be 20 years, 25 years, 30 years? How long is it going to be between the day they retire and the day they die? Okay, so liabilities of the defined benefit pension plan are in substance those of the employer. So a defined benefit pension plan might be set aside. It might be set aside in the case of a government in a fiduciary fund, or it might be operated by a third party. But no matter who has the actual assets of the pension plan, the liability is the liability of the government. So if Houston has promised its police a certain defined benefit pension plan, or it's promised its firefighters a particular defined benefit pension plan, then the city government, the Houston city government, has that liability to make sure that that pension plan is sufficiently funded so that they can pay out all of those retirement benefits. Okay, so how should it be accounted for? Well, like I alluded to earlier, we have to consider that interperiod equity. Pension costs should be allocated to the periods in which the employees perform their services. So for those police officers that are earning their pension now, we want to include that cost, basically, that pension-related cost in the current year, because now is when the police officer is actually earning that pension, although the cash payments are going to go out in the future. Okay. Why do we need to know the accounting rules around pension plans? So this is to give us insight into how good of a steward the government is being with respect to those plans. You as a citizen have a right to know how much debt the government has. And like we mentioned before, pension plans tend to be a large portion of a municipal government's debts. So GASB has set up rules for pension liability reporting so that way the citizenry and any other users of the financial statements have an understanding of how big that liability is. Okay, so GASB standards provide guidance for defined benefit plans that are either included as part of an employer's financial report or included in standalone reports. GASB standards distinguish between two categories of pension information: current financial information about plan assets and activities, and actuarial determined information about the funded status of the plan and progress in accumulating assets. We're not going to go too deep into actuarial science because that is an incredibly complicated arena, one that I am not an expert in, so I certainly would not want to go too far in that direction. But it is important to understand the role of actuarial science in determining pension liabilities. So, for example, you have current information about the plan assets. That's, let's pretend it were to be, something you could open in a Fidelity window and you could go and look at how much the plan is worth today. But then there's also important information that's determined by actuaries. For example, calculating the anticipated life expectancy of those employees, estimating their retirement, estimating their final salary to estimate how much of a pension they're going to be owed every year. There's kind of two different elements of information there. Okay. In addition to there being defined benefit and defined contribution, there's also different ways of structuring these pension plans. So, for example, a single employer plan is the most straightforward. So a single employer plan is like City of Houston has the Houston Firefighters Fund. That's a single employer and it covers only its employees. On the other hand, agent multiple employer plan is that governments each agree to participate using basically the same administrator, but everything is kept in separate accounts. So let's say, for example, and this is not a real example, but just, you know, for instance, let's say that City of Pearland, City of Alvin, City of Manville, they all agree to have one administrator for their pension plans, but that administrator is going to keep 3 separate accounts. They're going to keep 3 separate plans. They have one for Pearland, one for Alvin, one for Manville. But the advantage is that that administrator, they're basically sharing the cost of the administrator. So they have one administrator instead of each of these small cities having their own, you know, pension asset management department. They all share one. But the sponsoring agent merely provides administrative and investment services. They're in charge of putting the money into investments and then reporting back to the cities. And each of those separate governments is going to have a separate fund. On the other hand, you've got cost-sharing multiple employer plans. Employees of all participating governments are placed in a common pool. So for this case, you know, the Texas Teachers Retirement Services Fund is going to be a good example. You have a lot of different districts, and they don't maintain a separate account for each of the different districts. All of the different districts participate in that, and all of the pensions for all of the teachers are in one giant pool. Employers share all the risks and costs and contribute at the same rate, and the assets may be used to pay any employee's benefit. Okay, so that's just as far as structuring who's managing those plan assets. It can be held by that government separately. Several governments might agree to use the same administrator and investment service, or they might all agree to put it in one giant pool. Okay. Relationships between employer and pension plans. Pension plan, like I said, is that actual pot of money that's been set aside. The pension plan is that set of financial assets. It's the set of bonds and equity investments that's been set aside. The employer is who actually has the liability to pay into that pension plan. Okay. Oftentimes, pension plans take form of trust funds. On governmental statements, those are going to be represented as fiduciary funds. If maintained by employer, they must include financial statements like fiduciary funds. If the plan is maintained by an outside party, so you can hire somebody, a third-party administrator for your pension plan, then the employer must disclose information about its financial conditions. So either way, you have a responsibility to report to your public as a government, your citizenry, about what the financial condition is for that pension plan. Okay, so GASB statements number 67 and 68. GASB in 2012, so keep in mind that this is fairly recent, okay? So one of the important things I think that I want to kind of stress about pension plans is for a long time, governments really did not have to report much information to the public about whether they had been funding their pension plans. And I'm sure you've covered in your like ethics class, like the sunshine rule. You know, would you want this behavior to be published on the front page of the newspaper? And it's normally a pretty good guide for, you know, ethical or moral behavior. Like, would I want to have to disclose this? Well, for a long time, governments really didn't have to disclose a lot about the pension liabilities that they had, which just according to human behavior kind of motivates a different set of behaviors. They were more concerned about managing all of the financial elements of running a government that were visible to the public. Pension plans as something that were kind of not as readily apparent, or there was not as much information given to the public, were something that governments had less incentive to focus on, to concentrate, and to work on funding. Per GASB number 68, the government employer is required to report as its pension liability the difference between total pension liability and the net plan position. So they're required to report that net pension liability. And that net pension liability we're going to talk about a lot. What we're going to do is we're going to work through a relatively simple example of how to calculate the net pension liability, but it's basically just like, how much do you owe those future retirees? What is the total current value of that entire liability that you owe to those future retirees that are your current employees, minus how much have you actually set aside in cash or, in bonds and equity? How much have you actually set aside in plan assets? And the difference between those two is the net pension liability. Those two statements became effective respectively for years beginning after June 15th, 2013 and 2014. Okay, so this is relatively recent. I mean, it's been less than a decade that governments have been required to report as much information on pension liabilities. Okay. So how should the employer measure its pension liability? The net pension liability, as we said, is the total pension liability minus the total plan assets. Let's take this piece by piece. How do you figure out the total pension liability? The total pension liability is something that is determined by an actuary. Okay? The actuary must first estimate the amount that will be required to make cash payments to employees during their years of retirement. So make those assessments about how many years is it until they retire, how many years of payments do we need to make, how many years is it between when they retire and when they die, basically. What is the total cash payment that we're going to owe them every year? And then you figure out, you aggregate that for all of the employees in the plan. Now, keep in mind, for something like CalPERS or even like Texas Retirement System, these are, hundreds of thousands of employees. So actuaries often create like classes or pools of employees based on, their age and their type of role in the organization to try and create kind of general estimates. And they take into account things like gender and current age to develop all these expected payments. The actuary must disclose these payments to a valuation date. So for example, you take those total cash payments and then you need to discount them back to today's dollars, okay? So if you're not gonna pay it for 30 years, then you're gonna discount it back to today's dollars, and then you need to allocate that total cost over that employee's service period. So for example, when we're talking about a teacher, we'll do an example where we talk about a teacher and she's done 20 years of service, but she has 10 more years of service. Each time you calculate that cost, you need to allocate what that teacher has earned during the year, okay? Okay. So here's the super reduced form example that I'm using. I'm using a teacher. So we're going to talk about one teacher to start with, keeping in mind that for an actual pension plan, this is going to be, thousands or hundreds of thousands of employees. We're going to do it on a one-person example because, like I said, we're not teaching actuarial science. I just want to give you an idea of like how this is calculated. And doing it for one person to start with is a lot easier than doing it for everybody, okay? So let's assume that the teacher is eligible for 2.5% of the final salary for each year of service, okay? They taught for 20 years and they will retire in 10 years. Their anticipated final salary is gonna be $80,000. So we do have, so if they have 30 years of service and they earn 2.5% every year, then basically they're going to earn 75% of their salary in retirement. Okay? So they earn 75% of their last salary for every year that they are in retirement. So for example, for this employee, for this teacher, that means they get a cash payment of $60,000 every year in retirement. Okay. Then the next step is going to be to discount the total payments back to the current day. Okay, so that teacher isn't retiring until 10 years from now. Let's assume that we need to pay that teacher for 30 years. Then that first year they get paid $60,000. If we discount that back to today, so 10 years from now, we're going to pay that teacher $60,000. Then the value of that today is going to be $44,000. Now we're saying there's 30 years of payments. That 30th year of payments is actually 40 years from today, and that's going to be worth, $18,000. So $60,000 has to be paid 40 years from today. She retires in 10 years, and then we do 30 years of payments. So that one gets discounted back to $40,000. So the total value today of those $60,000 per year times 30 years, 1.8 million of total cash payments going to be due 10 years from now until 40 years from now is actually, the present value is $875,000. Okay, so we had to figure out the cash payments, and then we have to discount them back to today's value, $875,000. And then now we need to allocate that amount over that teacher's total service life. So GASB requires entry age actuarial cost, which basically means it's going to be a percentage of their payroll. And so what that means is if you assume that the teacher's pay is going to be increasing over their years of teaching, which is normally what happens because normally teachers are compensated at higher levels based on years of service, then more of the service is going to be allocated towards the end of that teacher's career. But basically for now, I've made some simplifying assumptions. Basically, so for that $875,000, the first 20 years of service, we have $525,000 allocated to the first 20 years of service, and then $350,000 is going to be allocated to that teacher's current and future years of service. Okay. How is the discount rate determined? Now, this is where actuarial science becomes fairly controversial, because although it's done with very complex math, it relies hugely on assumptions. It relies on estimating that discount rate correctly. Okay, so this is the most controversial because the lower the discount rate, so for example, if we have a discount rate of 1 or 2%, then the greater the pension liability. Because if you're discounting less, that $60,000 gets discounted less, it becomes a greater current liability. However, if you assume a high discount rate, 8% or 10%, then the current pension liability is going to be substantially lower. And we're going to do some quantitative examples in a second. According to GASB, the discount rate should be a single rate that reflects the long-term expected rate of return on plan investments to the extent that the plan's fiduciary net position is projected to be sufficient to meet future benefit payments. So for example, how much do you expect that you're going to earn on those pension plan assets? How much do you think you're going to earn on those government bonds and equities that you've invested in for your pension plan? And the other element that GASB says should be a portion of that discounting rate is not just how much do you think you're going to earn on your plan, but also using kind of a third-party measure, a yield or index rate on a high-quality 20-year municipal bond to the extent that the plan's net position is projected to be insufficient to meet future benefit payments. Okay, so you kind of have a composite rate where if you have enough money in your plan to pay for those employees in the future, then you can use that long-term expected rate on plan assets. On the other hand, as most governments are underfunded, so say 70% of your rate, because you're 70% underfunded, 70% of your, or you're 30% underfunded, you're 70% funded. 70% of your rate is going to be based on the actual plan assets, how much you would think you'll make on the plan assets. That remaining 30%, that underfunded portion, you're going to have to estimate that discounting based on a 20-year municipal bond. Now, why? Because we're talking about state and local governments. We're talking about municipalities. And basically the assumption, and it's a dangerous assumption here, but the assumption is in the case that you couldn't actually pay for those employees out of that pension plan, that instead you could issue municipal bonds and you could pay them out of that. Dangerous assumption. But basically that's the logic behind using this kind of blended rate between how much you think you're going to make on your assets and some 20-year municipal bonds, some 20-year government rate. Okay. Let's look at an example. Here's a quantitative example that I've created. And all of these are kind of like back of the envelope kind of calculations. So don't put too much faith in these. These are not like actuarially correct examples. These are just kind of like, what does it look like? If we take that same assumption, right? We did an example of a teacher that is retiring in 10 years, and they're going to be getting 30 years of payments of $60,000 each. And then we found that if we used a discount rate of 3%, that the present value of those future liabilities, those future cash payments, was going to be $875,000. That's if we use a relatively low discount rate of 3%. What about if we use something that's not even incredibly high? We'll see it's not even incredibly high relative to what governments use. But let's say we use a discount rate of 6%. If we use a discount rate of 6%, then the future value of the present value of those future payments becomes $461,172. And if we use the same kind of allocation for allocating it over the service years, before we figured out that our total pension liability for this one employee was $525,000. If we change just the discount rate, we're not changing any of our other assumptions. Teacher still works for the same number of years. Teacher still gets $60,000 a year in retirement. All we're changing is, one, our assumption about how much the government, about the discount rate. If we change our assumption from 3% to 6%, look at how much our total pension liability changes. Our total pension liability is half of what it was. Instead of having a $500,000 liability for that teacher, we only have a current liability of $276,000. That dramatically reduces the amount that we need to set aside. But nothing in reality has changed. Whatever discount rate or whatever return on the assets is going to happen either way, regardless of our discount rate. This is what makes it an assumption, and a relatively risky assumption. So let's take a look. What kind of returns are pension plans assuming? Are pension plans assuming a relatively conservative discount rate? Something on the low end, 1, 2, 3%, so that they don't underestimate their liabilities? Or are governments assuming that those plan assets that they have, that those bonds and stocks that they have, are going to return a high amount? This is what they're assuming. This is the Treasury 30-year yield rate. This doesn't even include any of our recent market activity, where if you were paying attention to those Treasury securities, they're down here in that like 1% to 1.25%. We looked at an example where we looked at 3% versus 6% and how much that change in the assumption is going to change the total pension liability. But here's where governments are at. Governments are assuming really high rates of return on those plan assets. They're using discount rates that are substantially higher. So for example, we talked about how GASB requires a blended rate, right? So GASB requires that governments basically combine these together depending on how funded they are. But still, it's still arguable that even if they have to use a blended rate, that this assumed rate of return is inconsistent potentially with what's really going on with markets and how much they really can return on bonds and equity. Okay. So continuing on our reduced form example, scaling it up. So before we were talking about basically just one employee, one teacher. We look at one teacher and we look at how much total pension liability we have for that one teacher. Now let's scale it up. Now I'm going to keep using that discount rate of 6% because that's more consistent with what governments are actually using. Not saying that they should, but it's more consistent with what they're actually using. So here's just a statement of the assumptions that we have. So for example, we have a senior teacher, 60,000. I'm using a lot of simplifying assumptions here. Let's assume that all teachers in their last year are going to make 60,000. An administrator, so for example, front desk staff is going to make 40,000, and an executive administrator, like a superintendent, is going to be making 90,000. Now let's look at, so number of years of retirement, 30. Everybody's going to basically live for 30 years beyond their date of retirement, and we're going to owe them 30 years of cash payments. But here's one of the important things. Those junior teachers are 30 years from retiring, mid-career 20 years from retiring, and senior teacher, which is the example we did, are 10 years from retiring. Administrators on average are 20 years. Executive administrators are 10 years from retirement. So I'm skipping a step here, but basically when you use those assumptions, you can plug those assumptions into the model, and I'm going to give you the Excel workbook to play with if you want to kind of see how these things are derived. But basically we saw, for a senior teacher, how much those full amount of cash payments are when we discount them back to today's dollars. So you can kind of see an example here where senior teachers, mid-career teachers, and junior teachers are all getting the same payment in retirement, right? They're all getting $60,000 for 30 years. But because junior teachers are further from retirement than senior teachers, they're 30 years away from retirement as opposed to 10, that 1.8 million gets discounted back to 143,000 in the case of a junior teacher versus 461,000 in the case of a senior teacher. Now, that's just, so we take the total, we find out the total cash payments, we discount it back to today's present value. Then the last step is we're going to allocate that across all of the years of service. And again, junior teachers are at the beginning of their years of service, right? And this is actually based on, the allocation is based on their salary, but it's going to be comparable to their years of service, right? So the total pension liability after actuarial cost allocation for a junior teacher, that 1.8 million that we owe that junior teacher starting 30 years from now, the present value, the current allocation for all of her service is only going to be 28,000. For a mid-career teacher, it's 103. For a senior teacher, which is the example we did, it's 276,000. She's basically 2/3 of the way through, so we've allocated like 2/3 of her service years based on that present value of the liability. For an administrator, 68,000, and then for an executive administrator, 415. So that's the like per employee type. What amount of pension liability after all the actuarial costs have been assessed. We figure out how much cash we owe them, we discount it back to today, then we do the actuarial cost allocation based on their service period. So if we want to look at a school district, assuming there's 500 employees with pension benefits, we have 175 junior teachers, 150 mid-career, 125 senior, 30 administrators, and 10 executive administrators. Then this total net pension liability, scratch that. That is incorrect. Total pension liability, I will try and fix that before I post the slides. The total pension liability for the district is going to be 61 million. Okay. So if we take, we did all the calculations, we figure it out, we get the total pension liability. Okay. What affects the total pension liability? We've already kind of indirectly looked at some of these, but there's a lot of different assumptions that go into the actuarial cost assessment. Changes in the total pension liability are affected by the following factors. the amount allocated per the actuarial cost method. So when we're doing that allocation across the service years, there can be changes in that. The interest on the total pension liability, benefit payments to retirees, changes in pension benefits, changes in actuarial assumptions, and difference between actuarial expected and actual experience. So we're going to look at some of those a little bit later, but there's a lot of different elements that can impact that total pension liability. Okay. So the one thing we didn't go into detail about the total pension liability. We need to break it down. Okay. So we did this effectively at a point in time. Okay. So 61 million was the total pension liability. But what we need to figure out is basically from year 0 to year 1, how much does that pension liability change? Okay. So we need to figure out how much does that total pension liability change, because the employer is responsible for the change in pension liability. And that change in pension liability comes from employees like serving the government and serving their district. So for example, teachers teaching for a year, those interest costs. So for example, we've discounted it back. Now as time passes, that liability increases, right? Because the discounting is basically undone by the passage of time. So let's look first at service cost. So for example, we did the example of the senior teacher. The amount that had been allocated to date as of like end of or beginning of year 1, end of year 0, was $276,000. Then the service cost for the current year is going to be $13,835. Okay. The interest cost. So we had in year 0, she was 10 years from retirement. In year 1, that teacher is now 9 years away from retirement. So we figure out how much that interest expense is, right? So you can simply take the present value of future payments times that assumed discount rate of 6%. But here's kind of a little bit more detail on how that looks and how that changes. But basically, that first year of retirement is now much closer to happening. And same, even that 30th year is much closer now, 1 year closer. So we take that 6% and we find that that interest is $27,670. Okay, so the total pension liability from year 0 to year 1, what is that interest expense? That interest expense is, you know, that passage of time, that 6% discount rate over the passage of time, that interest expense becomes part of that pension liability. And then same thing with the service cost. And this is, you know, per employee type. So for each employee type. So for the senior teacher, you have, you know, $7,000 service cost that she has performed part of her obligation. Okay. So scaling it up, those were just like individual examples. Scaling it up, say that there's 8 million of interest costs and 1.5 million of service costs. Okay. So those both change. Those represent the changes in the total pension liability. What's next? Total plan assets. So what's actually going on with those assets that you have set aside? Sorry. What's actually going on with those assets that you have set aside? So you have that separate pension plan that's either, you know, a fiduciary fund of the government or something that's managed by a third party. What can impact those plan assets? First, one of the most obvious is if you put more cash into that plan, if that employer contributes to the plan. So contributions from the employer into that pension plan. Also investment earnings, including realized and unrealized gains and losses, benefit payments to retarees, and administrative and other miscellaneous costs. But investment earnings, including realized and unrealized gains and losses, those are going to be the most, arguably some of the most important, some of the most consequential. Did those bonds and stocks earn the amount of money that you anticipated or not? Okay, were those gains what you expected, or did they come short? Did you end up potentially in the loss position, or just not a sufficiently strong gain? Okay, so for example, before we were talking about the liability, how much that school district owed to those teachers for their future retirement. Now we're talking about the amount of money that they actually set aside. So we're talking about the actual plan maintained by the district. So let's say that that plan maintained by the district, when we started out, they had, year zero, they had 40 million, they had 79% of it in stocks, so 31.5 million in stocks, and they had, just below 8.5 million in bonds. Now we look at the change. So we're going to look at the change from year zero to year one. From year zero to year one, the stock value increased 1.5 million, the bond value increased only 167,000, and the district contributed 5 million more. Okay? So they go from stocks, the value of the stocks goes from 31.5 million to just over 37 million. The value of the bonds goes from just under 8.5 million to around 9.5 million. Okay, and that's from the change in the value of the assets, just from those assets then being in the market, how much they have in terms of, in this case, gains. This was a gain year. Although what we're actually going to see for 2020 is definitely a loss year. Most years historically have tended to be gain years. Normally when you have losses, the losses occur fairly precipitously, whereas the gains occur over a much longer period of time. So for example, between the 2008-2009 financial crisis and now, we've had a long series of years that are going to have had realized or unrealized gains, and then now we're going to have for 2020 a year of losses, either realized or unrealized, depending on whether they actually move their positions or not. Okay, but I used a gain example for my school district example, even though it's not going to be representative of 2020, it's going to be representative of the previous years. Okay, so what was the difference between expected and actual experience? So if the assumption was that the combined rate of return on stocks and bonds would be 6%, then on that $40 million pension plan fund, if we expected a 6% return, we would have expected 2.4 million in return. The actual return was only 1.7 million. That difference was 650,000. We're going to talk about how GASB has certain rules for what's recognized right away versus what's recognized over an extended period of time. Gains and losses are going to fall in the category of things that are going to be recognized over a period of time. And in particular, GASB requires recognition of those gains and losses over 5 years. And they chose this very deliberately because it's a well-known fact that the market cycles up, the market cycles down. So GASB has specifically laid out that they don't want governments to have to recognize those changes in value of those plan assets in 1 year. That would create a lot of volatility in terms of the plan asset valuation. I'll leave it to you all as to whether you think it's a good or bad idea that this is kind of effectively smoothed, but the fact is that it is smoothed. So that difference would be recognized over a period of 5 years. So that 650,000 difference, that 650,000 like shortfall between expected and actual is going to be recognized over a period of 5 years in terms of the pension liability. Okay, so we've talked a lot about the pieces, right? We've talked about the liability, we've talked about the assets. Now we're going to try and bring it all together to create like one comprehensive picture and do the actual final calculation. So the net pension liability is that difference between total pension liability minus total plan assets. And the pension expense is going to be the change in net pension liability. So we're going to have year zero, we'll have our total liability, our total plan assets, and our net pension liability from year zero. And then we're going to have our total pension liability, total plan assets, and net pension liability from year one. and the government is going to be recognizing that change, that difference in net pension liability as the pension expense. Generally, that whole difference is recognized as the net pension expense, but as I just mentioned on the previous slide, there's certain exceptions that apply to this general rule. And we'll talk about those in a second. Okay, so for example, okay, we have the school district example. So we have the total pension liability at the beginning of the period. So end of year 0, beginning of year 1, the total pension liability. And then we have liability at the end of the year. So for example, this is a really simplified, oversimplified example. So during year 1, the only thing that we recognized as a change in that pension liability was the service cost. Those teachers continued teaching, so they earned more of their pension. And then we have the interest. So because we had discounted that total cash flow back to the present value, we are now 1 year closer to realizing all of those cash outflows. So we recognize the interest expense. On the other hand, we have that net plan position. So how much in terms of assets had been set aside. At year 0, the end of year 0, 40 million had been set aside in stocks and bonds to pay those pension plans in the future. And by the end of that year, the total net plan position was 46.7 million. So the plan had earned a certain amount of money, those stocks and bonds had earned a certain amount of money, and there were contributions to the plan of 5 million. Okay, so how does this impact net pension liability? Started with 21.2 as the net pension liability, ended with 24 as that net pension liability. That difference is going to be 2.792. So basically, let's call it 2.8 million is the difference. But we've got to be careful not to double count the contributions. Okay. So we add back in those contributions, that 5 million, because the pension expense we need to record is unrelated to the amount of cash that we contribute. So since the pension expense we need to record is going to be unrelated to the amount of contributions, we deduct those contributions back out and we add in the difference. So this is where we account for the fact that that difference between expected returns and actual returns was 650,000. We're going to add that back in, and then we're going to subtract the portion for this year, and we find that our pension expense is going to be 8.3 million. If this example didn't really make sense to you, there is another example in the book. It's actually a little bit more complicated, so it has a little bit more going on. But it's the example that you'll find at the bottom of page 433, and it continues through page 436, I believe. So you can kind of work through a more complicated example that includes other elements that might impact pension liability, net plan position, or net pension liability. How do we actually record these pension-related journal entries? So on the government-wide statements, you're going to recognize the pension expense for the year. Okay. So how much was the pension expense for the year? So for example, let's use our example here, 8. I'm going to use it in millions. $8.313, 8.3, oops, 1.3, okay? So we're going to debit that pension expense, 8.313 million, and we're going to credit that net pension liability, 8.313 million. Now, the cash contributions are going to be recognized separately, right? Okay, so we contributed 5 million. So that is going to reduce that pension liability by 5 million. Okay, you have an amount that you owe to your employees that's been calculated based on all these actuarial assumptions. Contributing cash to that plan reduces the liability, reduces that net pension liability, right? Doesn't reduce the total liability, it reduces that difference. Okay? So debit net pension liability and credit cash 5. But as we said, there's some exceptions to the rule that pension expense is equal to the change in net pension liability. First one is changes in actuarial assumptions. Those are going to be recognized over remaining service years. The second is difference between expected and actual experience with regard to economic or demographic factors. Those are going to be recognized over the remaining service years. If life expectancy changes, you're going to recognize that change over the remaining service years for your employees. And the last one is the example that we did kind of do, kind of in brief, is the difference between actual and projected investment earnings on plan assets. Those are going to be recognized over the next 5 years, always over 5 years. Okay, so for the other two exceptions, it's over the remaining service years. So you figure out, okay, my employees have on average, 15 years of remaining service years, and that's how you'd allocate it. But specifically for the difference between actual and projected investment earnings, that must be recognized over 5 years because GASB has made the assessment that that's the length of the economic cycle that we're going to recognize those over. Okay. Pension-related journal entries. Accounting for the 3 main exceptions. Okay, so we have those exceptions, and those exceptions may result in reductions to the pension liability or increases in the pension liability, right? So for example, when the plan is underfunded, that's going to result in an increase in the pension liability. For example, if something impacts expected mortality rates, then that might reduce the pension liability. If instead of having to pay out teachers for 30 years, you anticipate, oh, I'm only going to need to actually pay them out for 28 years, that's going to reduce your pension liability. Again, I know that's morbid, but that's actuarial science. Actuarial science is mildly morbid. Accounting for the 3 main exceptions made by GASB to account. So in the period in which the change occurs, if the change reduces the pension liability, then you're going to debit the net pension liability, you're going to reduce it, and you're going to credit deferred inflow of resources. And then over the subsequent period, you're going to recognize the relevant portion by debiting deferred inflow of resources and crediting pension expense. If the change increases the pension liability, then you're going to debit deferred outflow of resources and credit that net pension liability. And subsequently, you're going to debit pension expense and credit deferred outflow of resources. Okay? So these special exceptions are one of the items that GASB has specified can be recorded in those deferred outflow of resources and deferred inflow of resources. Remember, GASB has a very specific set of items that can be included in those categories. Okay. All right. Next section, shifting gears just slightly. Okay. A lot of that conversation was about how to record it on the government-wide financial statements, right? Those journal entries we just covered were about how to record those pension liabilities on government-wide financial statements. Now, we need to talk about how the pension plan is going to record. Okay? So those were the government-wide statements. Now we need to talk about that actual pension plan. The reporting for those, bonds and equities that we have set aside. How do we report those? So GASB statement number 67 says a pension plan is required to have a statement of fiduciary net position and a statement of changes in fiduciary net position. How much do you have in that plan and how has it changed over this time period? Okay. So the statement of fiduciary position, main assumptions of the pension plan are its investments, the main assets of the pension plan are its investments, and plan assets should be reported at fair value. Receivables are usually short-term, and normally that's just the contributions from the employer or other entities. Main liabilities are benefits currently due. So if you have people that are currently retired or currently disabled and qualify for the pension, the liabilities for the current period are going to be what you owe to those people that are going to have the that are going to be receiving pensions right now, or if you have administrative fees. So if you have a third party that you've contracted with to help you allocate your resources and you owe them administrative fees. The difference between assets and liabilities is reported as a net position restricted for pensions. Okay, makes sense. That asset must be set aside, it must be restricted. It has one particular purpose, paying for those pensions. Statement of changes in net fiduciary net position. Additions consist of investment income. So how much did those stocks and bonds earn, as well as contributions from employers and other entities. Investment income is generally interest, dividends, and other returns from investment. Principal deductions are payments. So what comes out of the pension plan? Those are checks that are actually written to the people that are receiving the pension currently, as well as investment and administrative expense. Okay, so that was talking about the plan, like what statements are required for the plan. Pretty straightforward. How much does the plan have? How much has that value changed? Who are you paying? Like, how much have you been paying to employees that are retired? How much have you been paying in terms of administrative expenses? Okay, types of disclosures. Obviously, pension plans are complex. If the governments were just required to like present these numbers without any additional context, it'd be very hard to figure out what's going on. So GASB requires fairly extensive disclosures for both the employer and the plan. So both for the government and for that particular plan. Description of plan benefits. What types of employees? How many employees are active or inactive? What are the contribution requirements? Information about the net pension liability, assumptions, alternative measures. So that's an interesting one. The governments are required to present it with their net pension liability with the discount rate that they actually use, as well as 1% higher and 1% lower. So you can kind of look at how sensitive is that pension liability to assumptions. Particulars to pension plan assets, liabilities, and deferred inflows and outflows of resources, and details about the changes. Disclosures that are required is required supplemental information include changes in total and net pension liability. Net pension liability is percentage of covered employee payroll, and actuarial determined contribution. So how much does the actuary say you need to contribute to keep that plan funded? Okay, so that was pensions. OPEB, other post-employment benefits. Sorry, I should have spelled that out. Other post-employment benefits is another highly related category here, right? So other post-employment benefits include basically like any life insurance or health insurance or other benefits that an employer maintains for employees after retirement, post-employment, in retirement, post-employment. They're a form of compensation provided in exchange for services. There are some exceptions. It's calculated similar to pension liability in that the other post-employment expense is going to be the change in the net liability, but GASB does allow for smaller governments to simplify their calculations. Okay. Switching gears again. Okay, so now we are no longer talking about pension funds or other post-employment benefits. Now we're switching and talking about fiduciary funds. Okay, fiduciary funds. They are not governmental funds. They are maintained by governments, but they are not governmental funds. Fiduciary funds. Remember, we have those three main types. We have governmental funds. We have the internal service funds and enterprise funds that are our second category. And then our third category out here is these fiduciary funds. Okay. Pension plans are one type of fiduciary funds, but there are other types of fiduciary funds. Fiduciary funds are account for expendable and non-expendable resources. There are resources that are held for benefit of parties outside the government. For example, in the case of pensions, employees and their survivors. But it could also be individual citizens and other governments. The measurement focus is economic resources, so they use full accrual accounting. Okay. those pension plans are going to be using full accrual accounting. All other fiduciary funds are going to be using full accrual accounting. Funds are excluded from government-wide statements. Remember when we rolled up all of our the previous sets that we've talked about when we talked about governmental funds and when we talked about like internal service funds and enterprise funds? Those get rolled up into the government-wide statements, and you generally get two columns. You get a column for governmental funds, and you get a column for those enterprise type activities, including the internal service fund. Those fiduciary funds are not rolled up because fiduciary funds, by their definition, are being maintained for third parties. They are not assets that the government has a right to just use. So they do not get rolled up into the government-wide statements. There are four main types. Pension trust funds, okay? That's what we spent the beginning of this whole lecture talking about was pension trust funds, okay? They're one of the biggest classes of fiduciary funds, but they're not the only type of fiduciary funds. So pension trust funds, investment trust funds, for example, when the government has a pool, when they hold cash for other governments. So if the state holds cash for local governments, they might have an investment trust fund. Private purpose trust funds, other than investment pools and pensions in which resources are held for the benefit of outsiders. So for example, private purpose trust funds might include scholarship funds that are held for the benefit of outsiders, and custodial funds, okay? Funds used to account for the resources held by an organization in a purely custodial capacity. When we talked about property tax revenue, generally, property tax revenue is not collected separately by each of the school districts, municipal utility districts, cities, etc., right? It's collected by one organization, for example, in Harris County, the Harris County Tax Assessor's Office, and then that county keeps those in a custodial funds and then redistributes it to the appropriate person, like the appropriate school district for that particular property tax fund. Okay, permanent funds. Permanent funds are a governmental fund. Permanent funds account for non-expendable resources. The resources benefit the government, okay? The reason this is here is because we're trying to contrast. Something might be held basically in trust. Something might be held as a non-expendable resource. That does not make it a fiduciary fund. It can be a permanent fund if the resources benefit the government, okay? So how you determine whether it's a permanent fund or a fiduciary fund is the government holding it for itself? Then it's a governmental fund. Is the government holding this money for somebody else? Then it's a fiduciary fund. So with a permanent fund, they account for non-expendable resources. The resources benefit the government. The measurement focus is going to be current financial resources. It's a governmental fund, so we're going to be using modified accrual accounting. Funds included in government-wide statements. Okay. Investment income. Income from permanent non-expendable funds is intended to benefit other funds. Government 34, GASB Statement 34 directs that governments should report permanent fund investment earnings as specific program revenues in their government-wide statements if they're restricted to a specific program, or just as general revenue if they're not restricted to a specific program. Okay. We didn't spend a lot of time about the other types of funds. The majority of Chapter 10, the emphasis was definitely on pension funds. Thank you for sticking with me today as we talked about pension funds.